In a world of constant change and innovation, trust is key, knowledge is power, and the inside track is everything. And now, ladies and gentlemen, please welcome your host, Bruce Whitfield.
Hello, everybody. Welcome to Inside Track. 4 fabulous guests for you today, including, and we'll start off with Norman Raad, who is the Chief Executive of Broll Auctions and Sales. Also to John Loos, the FNB Economist. We'll find out how 2021 played out and whether or not there's any respite coming in 2022. His colleague from FNB Commercial Property Finance is Sagan Ramlingam, and then Neil Mckinon. He's a lawyer. Don't hold it against him. He'll sue. He is with Hammond Pole Attorneys. We're going to talk about the new regulation that is coming through in terms of the property regulation and legislation in the next 12 to 18 months or so. Let's kick off with the boss, with Norman Raad this afternoon. It's good to have you with us, Norman. How was 2021? I'm still struggling to get into the framework of 2022, but did it play out better than you might have anticipated 12 months ago?
Yeah, Bruce, we've had this conversation, and yes, I mean, remember, we started off very well. I think people thought COVID was over, and then we had a bit of a bump in the road in April with the new virus and the new strain, and then obviously there was the looting, which put a lot of strain on the economy. But towards the end of the year, we saw a lot of activity, a lot more buyers start filtering through and participating at the auctions. Especially in the industrial sector. We saw a lot of properties being traded in the industrial sector and the logistics side, and even surprisingly enough in land. Not a lot of properties were sold amongst the retail sector, I think because of people wanted to hold on to their jewels and their prime assets. With regards to commercial, still struggling. I think the commercial offices to convert to residential is a play we'll see for the next maybe 5 to 10 years, with the undersupply and over demand in residential for the residential space. So yeah, it was quite a good year for us, but I still think we're a long way to go. And I think this year, sentiment already, our phones are ringing, people are participating, and it doesn't mean the prices are going to go up on the assets. I think the sellers need to still be realistic. They still need to understand where we are on the road that we're going to travel. We've been through a tremendous difficult patch, but I think going forward, there's a lot more people willing to participate and inquiring about assets. And again, the predominant sector is the industrial sector.
Just how much of a re-rating has there been from pre-COVID to 2 and a bit years in?
Yeah, so I think overall, when you talk about re-rating, I'm talking about the valuations of properties. I think some sectors have taken a massive pounding. I don't even think the valuers. I don't want to upset anyone here in the bank, but I don't think even that has been corrected to the full degree. I think there's still a long way to go with those assets. I think we'll find some more devaluations over the next period in certain sectors, but I think. Overall, I would say about 30% at least over the last 24 months.
And then clearly buying opportunities present themselves, and it's premium property all the way, because suddenly when you've got lots of sellers in the market and a handful of buyers, and as those buyers increase, of course, there's more competition, but surely early movers are being well rewarded for being courageous.
Yeah. So I made a statement last year, and I said, if you're not buying now, you'll never buy, and I think I stick by that. I think what's happened is that there's been some real deals. I think now into April, and I'm talking about D-Day, is that the reprieve from some of the banks, a bit of the concessions that have been made to the clients, they'll reach maturity in April, and I think we'll see a lot more assets come to the market where they're going to be needing to be sold. And I think that could filter in through to the industry, a lot more properties for sale. But yes, I think there's a lot of opportunities. Properties, I'll just give you one example. Northcliffe Corner was sold in our last auction, and the buyer didn't perform. But that property has basically been sold for less than half price in this current market. It was been on the market for about 125, 130 million prior a couple of years ago, and we're not going to get anywhere close to that right now. So those are the assets that are coming to the market. There is demand at the lower and the good value properties, and we've seen that filter through. We got a property in Wynberg. I've seen the valuation. The valuation is sitting at near 20 million rand, but we must probably get between 10 and 13 million rand on the next auction for this property, which is a massive discount to the historical value.
Sagan, why are you guys getting the valuation so wrong?
Well, I don't think so, Bruce. I think, the fundamentals of valuation is still around supply and demand. And I think as long as you have that, and if there's a willing buyer and a willing seller, then you're going to get a value that's suitable to both parties. So I don't think we're getting the valuations wrong. I think, to your earlier question about whether there has been a reduction in values, I think we have definitely seen that. Particularly around the commercial property and those assets that are coming onto the market. We have seen, and John can probably highlight that a little bit more as well. We've seen like 15-20% reduction in values of a number of properties that we've come across. So I don't think we're getting the valuations wrong. I think value is still based around willing buyer, willing seller. And obviously
John,
the investment components of that, yeah.
John, what are you seeing from an economist's perspective in terms of the pullback that we've seen? Very clearly has been a pullback. There's some disagreement as to what the quantum is, and I guess it depends on property, on quality and location and demand for that particular site. But what are the numbers telling you?
Well, if one looks, I use MSCI data, and it is a bit lagged. We've only got up until the first half of last year. But through the 2020 and to first half of last year period, all commercial property categories lumped together, there was an average decline in capital values of about 9.5% up until then. It's probably more by now. I think last year as a whole would have probably seen deflation in values. I don't think it's quite corrected yet. I would agree with Norman. Corrections in markets don't quite keep up with supply and demand fundamentals. They do lag it a bit, and you move then away from demand supply equilibrium for quite some time. And we're probably most away from that equilibrium in the office market, to a lesser extent in the retail market, the industrial not too bad. And that comes out of our broker surveys where they're talking about the office and to a lesser extent retail as being very well oversupplied at the moment, supply versus demand for buying, that is in the buying market. So there's still some correction to go. I guess the question is, does it carry on correcting in nominal terms or or go back to real terms? And what I mean by real terms is that's the way a lot of corrections happen when you've got a more sort of stable economy, and our economy has improved from 2 years ago quite significantly. The tenant payment performance has improved from 2 years ago quite significantly, but it's not wonderful. And what I think this year would probably happen is we'll get to a situation where you'll go back to average value growth on a nominal basis, but very low, very, very low, 1 or 2%, whatever it might be. More in industrial and office and hotels, for instance, still probably in decline. But on average, maybe some slight growth. It doesn't keep up with general inflation in the economy, and therefore, in real terms, you're still correcting on an average basis. That's where I see it getting to this year.
And it doesn't also correct in terms of the cost of building, because building costs are outrageous at the best of times. I mean, cement costs are increasing, labor costs are increasing, probably at a rate higher than inflation. At some point, that gap gets so big that buying existing property is an absolute no-brainer.
Yeah, probably not there yet. It depends what you're looking at. But certainly in the office sector, for instance, I would think that the bottom of the best buying opportunity is still coming. Big vacancy rates still rising. Almost no need for any further office building activity, and office building activity is very low at the moment. So. It's a better and better buying opportunity still, but the best one probably hasn't happened. In industrial, probably not the case. We're probably at the situation where, the market gets to equilibrium and values stop declining. But for commercial space overall, there is just probably there's ample to go around. As I say, more in the area of retail and office and hotels, for instance. There's very little need for new building activity.
When one looks at the office market in particular, just recently been getting a lot of emails from people saying, my company's forcing me to go back to work. I don't want to go back to work. I, be used to working from home, and now they want me back for 3 days initially and then 4 days. And they say that's going to be permanent. I thought that work from home was the new thing. And I'm getting quite a lot of people whinging about their bosses. They have enormous trust that I'm not going to bust them to their bosses as well. But one gets the sense that companies are impatient to get back to work. I know Jacques Sallier, the boss at FNB, just as soon as this pandemic started and everyone went home, he was champing at the bit to get everybody back to the office.
The bosses seem to be uneasy about people working from home. They like to see them or something. It's some psychology behind it. But the reality, Bruce, is that if I look at surveys from the US, the employees definitely want more flexibility, or a bigger chunk of them. The bosses, a bigger chunk of them, want people back at the office. And it's going to be somewhere, they're going to have to find middle ground, because those companies that are too inflexible are going to lose skills. This is a big selling point at the moment. The more progressive companies are going to acquire skills with the offer of a more flexible working arrangement, amongst other things. So that's the competitive environment they're dealing with. So I foresee it. They talk about the hybrid these days, a mixture of two, and that's where I think it's going to settle for now. People who were maybe 5 days at the office are going to be 3 days at the office. Those who were 3 days at the office, maybe 1 day at the office. Less time at the office for those who are office bound, a bigger portion working from home full time. And then there's a new development which is also a challenge for office landlords, and that's hoteling. FirstRand, we're doing it now. Those days, it was very wasteful and I saw it before COVID already, forget about COVID. The head office I work in, a lot of desk space standing empty at any given time of any given day of the year. People are on leave, people are out for the day, on client visits, they're sick leave, whatever the case may be. And that was just wasteful. Now the software is being installed. You go online and you book your desk for tomorrow. If you don't book one, you don't have one. So hoteling increases the efficiency of desk use. We won't need as much desk space, therefore. The empty desks are not reserved for someone. And that, I think, is a relatively new development now in the software. The technology is there, and that will that decreases demand for office space as well.
You say it's a relatively new development. I recall going into the offices of Anderson Consulting. Remember them? Very, very good at shredding. It was like their third skill that they had in the business. But Anderson Consulting, they had hot desking as something 20 years ago. And it was working back then. And people would bring in their laptops, were about 7 times the size of current laptops. They would hoik them in on a mule and then plug them into the networks. I mean, this stuff isn't brand new, but
no. Look, hoteling is a more efficient way than hot desking. Hot desking is just a sort of a free for all. But what the COVID-19 forced lockdown experiment has done is to force all the late adopters onto this, whether it's Zoomifying their interactions or corporate bosses realizing how wasteful the desk space utilization is and employing this hoteling software. A lot of the technology and everything was there already. It's not new, but it's just forced the late adopters onto it.
So, Grant, we've got Norman Raad who's saying if you're not buying, you're snoozing and you're going to miss out on an opportunity. We've got John Loos saying, particularly in the office space, there's still quite a lot of runway to go. There's no need to rush in and panic. Is this a renter's market? Is it a buyer's market? Or is everybody getting a good deal?
Yeah, I think it's a mixture of both. I think Norman's right. I think the biggest opportunities were probably last year and so on, when there was like a mini panic, if you want to call it, in the market, and there were lots of properties available. So those properties where, if you want to call it a bargain or a buying opportunity at that time. But I don't think it's completely lost. I think those opportunities still exist. We're seeing a lot of inquiries or buying in the lower end of the market at the moment, particularly properties for own use. So there's lots of that, and I think Norman and John mentioned, opportunities in the industrial property sector as well. Lots of opportunities in space for warehousing. So companies are still looking to buy, and I think it's still a good investment opportunity.
What is the obsession with owning in a world where we've decided we don't need to own our hotel, we'll just Airbnb. We don't need to own our car, we'll Uber. We rent virtually everything nowadays. We don't even have our own servers. We rent space in the cloud. What is the obsession with owning physical office space? Either it's because there's a wonderful buying opportunity and the stuff's never going to be as cheap again, it becomes an asset on the company balance sheet, or people have all gone completely mad.
Yeah, I think if you're looking in the small and medium enterprise, Bruce, I think there's a case for, in my view, there's a stronger case for buying and owning your property. I think the most important one is obviously security of tenure. And then, ensuring that the property is suitable for your business and the longevity of that business, so that you manage those costs. There isn't long-term escalations that the business can't afford, etc. So that for me is the main reason and fundamentally important. But I think the other thing that's important for me, and particularly ownership for the SME businesses, is that it also provides those owners with some sort of retirement funding when they leave the business or when they sell the business. So I think those two factors are important for me in that SME market in particular. I understand what you're saying about, the world is going towards renting rather than buying. But I think the way the economy works at the moment, and particularly in that SME sector, it makes sense to own an asset that they could use for multiple purposes.
Now, John Loos, at risk of putting you at war with your esteemed colleague, surely rental gives you a lot more flexibility. If you were a property owner in Governor Beki Avenue, for example, the old main road of Gqeberha, formerly known as Port Elizabeth, you owned a property there 20 years ago, and that was your business premises, and you were in a fixed property that you owned. You now own a property that you don't have the same foot traffic, you don't have the same customers. That time is gone. If you owned retail property in Yeovil, for example, in Joburg, or certain parts of Sandton where traffic has fallen off a cliff, you're quite restricted in terms of ownership. You don't have the flexibility that a renter might have.
Yeah, I guess, being a tenant, you load a lot of that sort of location risk and, changes to the city that could happen. You offload a lot of that on the landlord. That's the advantages of renting, that greater flexibility. I guess the benefit of owning is your more control over the property that you own, to do with it what you like, to redesign it how you like, and there's greater sort of decision making, I guess, over a property. So I guess it depends what you desire, but I hear you. In a developing country city, that's location risk, and we know that a place like Joburg changes rapidly, areas change rapidly. There is that risk, if you own properties, and many a landlord has battled as a result. So you've got to be sharp if you're owning, and you've got to know when to move on, and to sell and move on. You've got to have your ear on the ground and see the signs of change coming. We know what happened in the Joburg CBD many years ago.
Yeah, absolutely. And many property owners there are still, of course, trapped in those properties and with huge negative equity in those properties too. Neil Mckinon from Hammond Pole Attorneys. You are now in partnership with Broll. When it comes to regulation, when it comes to the rules of ownership versus rental, is it becoming easier to own? Is the regulation? I asked this question with my tongue firmly in my cheek, because when it comes to regulation, things are seldom designed to be easier or better. But how's the regulatory landscape changing?
I don't think there's too much regulation in terms of owning property, but there's definitely a lot of regulation in terms of acquiring property and all of the property professionals that are involved in the process. So, we've most recently come through the POPI Act, and there's various privacy laws and requirements that property professionals and agents in particular that have had to follow those types of rules. So from that perspective, definitely the admin in terms of preparing property for sale has become a little bit more tied down. So it's becoming a little bit more regulated in terms of FICA, and more recently now the Property Practitioners Act, which is about to be released. So that's going to add a little bit more regulation in terms of property professionals.
Does it add any level of greater certainty, security to the process, or is it simply an administrative difficulty?
No, definitely. It adds a little bit of everything. Every piece of legislation is designed to protect one of the parties. And one of the big defining issues in this Property Practitioners Act that's about to come out is the property practitioner's requirement to provide a declaration of the property. So not only are sellers obliged to then declare issues with the property in terms of latent defects and faults that they know about, but in fact it places an obligation now on the property practitioner, on the agent, on the person that's actually dealing with the property in the background, to also make sure that that's disclosed. So for instance, the definition of a property practitioner actually extends quite far now. It's not necessarily only an estate agent or only a broker. It actually includes other people that are involved in property as well. And they would then carry the liability of having to disclose certain issues or certain circumstances about a property.
How much does that complicate your life, Norman Raad, as Chief Executive of Broll Properties and Auctions, if you are now having to do far more detailed due diligence perhaps than previously you might have had to?
Yeah, well, it's just more people in the office and more people to do admin. No, so I mean, we're fully behind the full disclosure of almost everything that we need to present to the buyers. We represent the sellers when we take properties to auction, but at the same time, we also represent the buyers to make sure that they're going through a seamless process, so there's no comebacks, afterwards. You never told us about this, and this is what happened. So we've been on that page for a long time, and I know just this regulation and these laws are here to just basically make it a bit more formal. But we've been part of that process. So we've got an admin staff that focuses on that, and we continue. I have to ask you a question, though. I mean, I know. What flexibility is in the lease? Because I advocate buying properties. That's my job. I need to sell properties. I need to sell properties. But I'd like to know the flexibility you talk about in the lease.
No. Well, you get to the end of a lease, into the end of a 5-year term, and at least you've got the option to renew or to run screaming. Which, if you own the property, of course, becomes a little bit more difficult.
I've got a few clients right now that are in a lease and they can't get out the lease, and they're going to be there for a long time. And if they own their own building, as they were supposed to buy their own building and be in the right position at the right time, they could have weathered the storm and gone through COVID with a bit more ease. Then right now have to...
and that's an important point to make here, Norman, because leases generally are done in favour of the landlord. The landlords are experienced at these things. They know how to tie a tenant in for a period of time. So talk to me about the benefits of ownership then over leasehold.
Yeah, so I mean, obviously, if you're looking for the flexibility of, then you'll be signing a shorter lease, and then you would be... you'll have that in your ammunition too when you want to renew it, and then you have the opportunity to move into a more favorable position or property and go to the market. And when there's a lot of demand, then obviously there's limited space for you to lease. But in the current environment, we've seen a proper 180. I mean, it's where now the tenants, they want to get out of the lease, they can't, because the landlord can't afford to let them go. They won't replace that space. They might never not replace that, especially in the commercial sector, for years. You know, I've seen empty buildings now over the last years, and I don't think they will ever replace that space with the former tenant that they had. They should have made good on that tenant. They should have accommodated them and tried to do everything possible to keep them there. Owning your property, if your infrastructure or if what you need in the position is relevant, if you need to be in that high profile position, you need to be in that environment, and culture's everything. I think today in the current environment, business culture, if you're trying to create something, it's no good you wanting to leave or have to leave in 10 years' time or when your lease is up. People like going to a certain destination for their work.
And there's that security of tenure, particularly if you are investing in a high-profile property with a dominant position. We keep going back to Northcliffe Corner. I don't know why people haven't snapped it up, but it's such a dominant position on a busy road, great access in and out. I mean, you would think to yourself that landmark sites like that would be in huge demand.
So there is demand, but at the level what the use will be today. So that usage has gone, it's changed. You know, over the years, the whole retail, the whole experience has changed. You know, and people aren't going to a Northcliffe Corner. There's many shopping centres around that environment. But I can promise you, when we sell that property, the new developer will create something really special, and that property, when they're complete, will be in demand. So I mean, from that point of view, I think that all properties have a cycle. But remember, you invest in property. If it's not an owner-occupier, there's still the investment side of the property. You sell it, they pay you, you go to sleep, they're still paying you. At the end of the month, they pay you again. Next month, they pay you again. So you're not buying bricks and mortar, you're buying a business. So if anyone wants to go and invest in a business, there's no better business than a property with a good tenant or a sustainable property with good tenants, you know, that offer an experience. And I think that's what we've seen, that people are chasing our cash flow, good properties with good tenants, with a good mix, with sustainability in the next 10 to 15 years, that if we go through another cycle, that those kind of properties won't be affected as much.
What's happening to the developers, Norman? I mean, yeah, you've got developers who must have really struggled, particularly in 2020, in the deep, dark uncertainty of COVID. Their business would have collapsed overnight. The survivors, or are you seeing some old names and old faces popping back up again and beginning to pay interest?
It's a very interesting question, because we've been part of that, and we've done some of the liquidations and sold some of the assets of those big companies, and we've seen it happen. We've seen the valuations of all the properties that they've owned, that once were actually assets in their balance sheet, and they just wanted to get rid of them to settle their debt. But I can tell you right now, basically the developers and the construction companies have moved to where the market is, and the market right now is in logistics and in residential. And they're focusing on that, and that's where they are. And it's been very active, and they've just basically been adjusting and been a bit flexible within their own kind of business offering, you know. So residential developers are flying, you know. I just heard of a company today, actually, the CEO, one of the main shareholders are here today. They're looking for opportunities. They're looking to build. They've got a war chest to go and buy, see opportunities and develop. So, and that's a major construction company that I would say a few years ago, 4 or 5 years ago, they were at their backs against the wall.
Yeah. No, the cycle, I think, is playing into some people's hands really, really well. Neil Mckinon, you are probably the best barometer that we've got on this panel of the volume of work that is happening in the market at the moment, in terms of property transfers, in terms of the amount of work that there is occurring within the property sector. What are you seeing in terms of the big trends?
I think certainly during COVID, if I can start there, I think when COVID struck, everybody thought, well, that's the end of it. Where are we going to end up? You know, everybody thought that was literally the end of the world. But obviously that gave an opportunity for the interest rates to come down so that, you know, the market could open up again. And that definitely towards the end of last year or the year before, we saw a great influx, definitely for first-time buyers. And it opened up the market a hell of a lot for first-time buyers to now get in, and then definitely for people wanting to upgrade. So in terms of numbers, I think we've definitely seen an increase over the last 2 years. And that's got obviously got a lot to do with the interest rate and movement, and also the bank's attitude towards first-time buyers in terms of loans and that sort of thing. But I've no doubt that it will sort of plateau out a little bit somewhere along the line. But the market is still there, and definitely we're still seeing the numbers. We're very happy with it. We can't complain at this stage. But yeah, it's definitely, the numbers are up, and I think those stats are reiterated by various property professionals that have released market reports.
Mckinon, thank you. Hammond Pole, who, of course, in association with Broll, on the point of interest rate increases, John Loos. I mean, interest rates going up around the globe. Everyone except the Chinese seems intent on raising interest rates at the moment. At what point do rising interest rates become a constraint on this property sector, which has got enough headwinds as it is? Are you worried about that?
Well, I think probably quite quickly on the residential side. On the home buying side, there's two residential markets. It's rental and buying. I always talk about the rental market and buying market as something separate. I think what we see this year is the residential market is more sensitive to interest rates, whereas the sort of GDP is more a driver of commercial. And so I think what the start of rising interest rates does is it just gets a portion of aspirant first-time buyers to postpone their purchase and maybe hang out in the rental market for longer, or at home with mom and dad for longer, and until the rate hiking cycles open. That's what we typically see. But what it then starts to do, I think, is push the rental market stronger. So we sort of seeing a bit of a tapering off in the home buyer demand during the course of this year, as we expect rates to rise gradually further through the course of this year. And the rental market, which was in a very weak state last year at a stage, very high national vacancy rate according to TPN, and some rental deflation, I think starts to turn the corner and gets back into positive rental growth and does a little bit better. I think that's so. So the two markets of residential sort of converge on each other a bit. At one stage, it was just way out of, you had this very strong home buying market and this very weak rental market.
But isn't it great, though, John? I mean, just from an economic perspective, that we've got a new generation of homeowners, of property owners. It may be 50 square meters, it may be 500 square meters, whatever the person's appetite is for property and their capability. But we've got, low interest rates have created an ownership culture once again, which is very exciting.
Yeah, this rate cutting from 2020, you saw a surge actually across the globe in home buying, and a lot of it first-time home buying. They typically go out and they think it's the time to buy when interest rates are cut and interest rates are low, rightly or wrongly. But at some point interest rates have to go up. So what goes down does go up in terms of interest rates. So, but the home buying, it's more of a thing on the residential side, it seems. In the commercial space, I think a bigger chunk of businesses are just happy to lease. In South Africa, especially, there's this very strong home buying culture. There has been for decades. People want to get onto that home ownership ladder, and as soon as interest rates allow it, and more important, or very importantly too, is employment opportunities. That's the thing that's just lacking at the moment, is greater employment opportunities. We're not seeing much employment growth, and with all our structural challenges in the economy, unfortunately, for the foreseeable future, I don't expect to see major employment growth.
And that, of course, will constrain then growth in the residential market. How then, Segrin, does that play out in commercial property, in the shopping mall business, in the industrial business as well, which has had such a good run for the last couple of months?
Yeah, Bruce, I think that's a very it's an important topic and a massive topic for the bank in particular. We have analysts that track these interests and so on. But I think if you look at interest rate hikes since 2008, we've only gone up in a band of about 200 to 250 basis points, if you take any 5-year chunks in between from then to now. So I think if you have that trend, and as a business owner, you are able to build that into your cash flow modeling when you are investing in property in particular, so you plan for it. So the savvy entrepreneurs definitely plan for it, together with ourselves for that matter. Whenever we look at a property transaction and want to finance it, we do interest rate stresses on that affordability before we actually determine whether that client can afford it or not. So I think that's what we do.
What is your worst case scenario that you're working with at the moment? I mean, we have seen South African interest rates going towards 25% historically. I'm not for a moment suggesting we go back there at any point in the foreseeable future. But what are how much stretch are you doing in your stress testing?
Yeah, so I'm not the expert, as I said to you. In fact, we've got people that specialize in monitoring interest rates and so on. But as a banker stroke layman, if I look at the trend, as I said, since 2008, and I think the 2008 scenario was the worst we've ever experienced in South Africa and internationally. Interest rates have moved up within a band of about 200 basis points, and I can't see that moving beyond that as well. I mean, even as we speak, our interest rates are currently still lower than pre-pandemic. So we're still in a good cycle, I think.
Yeah, absolutely. Norman Raad, final word to you. Outlook, how are you feeling about the year of 2022? It's always challenging, it's always choppy, it's always difficult, but that's where the opportunities sit, I suppose.
No, I think this scary movie that we've been in, people have settled in, and I think people are now starting to participate in basically a better ending. I think we've seen a lot of people talking to that we haven't seen before. People want to get on with it. We South Africans we want to get on with it. We want to buy properties. I think everyone if you're going to live here, if you're going to stay here, if you're going to carry on working here and growing here and developing and investing in your environment, your family, you want to own property. And we're very bullish. Our clients are bullish. We've got a lot of new buyers or old buyers that are participating again. And I just think COVID, if I want to give you one word for COVID, it's uncertainty. COVID just brought uncertainty. No one was sure. I think people are quite relaxed now. They know where we've been, and I think they're positive about where we're going.
Norman Raad, thank you. Norman is the Chief Executive of Broll Auctions and Sales. Also to John Loos, Property Economist at FNB, to his colleague Sagren Ramlingam, thank you very much indeed, from FNB Commercial Property, and also to Neil Mckinon from Hammond Pole Attorneys, and they're in collaboration with Broll. Thank you very much for watching us and for participating on this edition of Inside Track. And until next time, have a very good auction.
Thank you.